We're very excited and proud to publish and present the new In Gold We Trust report. We're writing this report for 13 years now, and this edition is definitely a special one. It is not only the longest, we wrote more than 300 pages, so we hit a new all-time high, but it's also the first edition that we are publishing not only in German, in English, in an extended and short version, but we're also publishing for the very first time in Chinese. China, for us, but also for the gold market, is a crucial market. It is not only the biggest gold producer, it is also the biggest consumer of gold, and therefore we said we will make this big step and publish a Mandarin version of the In Gold We Trust report as well. We've invested more than 15,000 hours of researching, writing, layouting, proofreading this report. It is a very special edition because we think it is a very diverse report. We are covering so many different topics, from the Chinese gold market to, of course, portfolio characteristics. We've got 4 fascinating chapters about mining. We've got interviews with Jim Rogers, with the legendary blogger Fofoa. So it is a very, very extensive read, and I hope that you'll all enjoy studying our new In Gold We Trust report. The leitmotif of the new report is trust, and the title of the report is Gold in the Age of Eroding Trust. Now, this might sound a bit philosophical, but we are all recognizing that trust is crumbling in many areas of our lives. We're seeing it in media, we're seeing it in society, we're seeing it when it comes to science, and we're also seeing it, of course, when it comes to politics. An area where we still see quite a lot of trust, and one could also say a trust bubble, is financial markets, and especially the US economy. The whole world believes that the US economy is far better than the rest of the world, and from our point of view, it is mainly driven to massive fiscal stimulus under Donald Trump, as well as debt creation that we have never seen outside of recessions. From our point of view, the US might enter a recession very soon. Perhaps the US is already in a pre-recession phase. Now, why is this important for gold investors? We crunched the numbers and we came to the conclusion that gold is one of the best portfolio hedges in an environment of a recession. Why? Because gold discounts that monetary and fiscal stimulus will implement it. Now, we're already seeing, especially in the Eurozone, that there's no room left at all for lowering rates, while in the US, at least, there's some leeway to lower rates. But on average, in the course of a recession, interest rates are lowered by 500 basis points. So even the US would go deeply into negative territory. Now, this is the reason why we have just seen that the Federal Reserve issued some academic papers about negative interest rates, of course, being very favorable. And we're also seeing that another round of quantitative easing and something new and kind of fancy, like MMT, modern monetary theory, is now gaining in popularity in the US, but all over the world. Now, from our point of view, this is monetary insanity. From our point of view, it is clear that in such an environment of huge monetary experiments, it makes sense to hold the oldest and the most stable currency that is around, gold. And therefore, we clearly see that this massive trust that we're seeing in the US economy and in the US dollar will start to crumble very soon. Many people are a bit disappointed when it comes to the performance of gold. From our point of view, gold is performing very well. In euro terms, for example, gold is up almost 5% since the beginning of the year. Since the euro was launched as book money 20 years ago, gold is up 360%. On an annual basis, there was a performance of 7.8%. And we can also see that gold is trading at or very close to new all-time highs in the Canadian dollar, in the Australian dollar, and in many other currencies. But still, the whole world is only following the dollar price of gold. And we have seen that last year gold was down roughly 2% in dollar terms, while we have seen a massive dollar bull market. Now, from our point of view, the dollar will tend lower in the next couple of quarters, because the reason for most of the dollar bulls is that the US dollar and the US economy is the cleanest dirty shirt. From our point of view, we are seeing massive skepticism when it comes to the euro. We're seeing massive skepticism when it comes to many other currencies in relation to the US dollar. And therefore, I think that the surprise might be on the downside for the US dollar, especially in the course of a US recession and a more dovish Federal Reserve. Because we have seen that the Federal Reserve started this monetary U-turn a couple of months ago, and from our point of view, we will see lower rates, we will see more quantitative easing, and we will see definitely a highly accommodative policy in the US, and this should be a boost for the price of gold. Another topic that we are analyzing every year is the de-dollarization. Now, the whole world, it seems, wants to diversify out of the US dollar. Last year, we have seen central bank buying the highest amount of gold since the year 1971. So the largest central banks bought more than 650 tons of gold, and this year, based on forecasts of the World Gold Council, central banks will be massive buyers again with more than 600 tons of gold. And it is not only Russia, China, Kazakhstan, Turkey, for example. It is also other countries that we're seeing buying gold for the very first time in ages. We have seen Hungary, for example, buying gold. We have seen that Poland was buying gold, and therefore this de-dollarization from our point is also a consequence of the lack of trust in the political system. We're seeing repatriation of gold happening. So Romania, for example, wants to get its gold back. We have seen that Germany brought back its gold, also Austria and the Netherlands. So this is definitely a part of the whole eroding trust that we're seeing in politics, in long-term alliances, and also in the monetary sphere. From our point of view, this de-dollarization will pick up momentum, and gold will play a major role in the next monetary system whenever it is implemented. Inflation is, of course, a very crucial topic when it comes to gold. Now, at the moment, nobody really sees inflation, so rising price inflation, as a risk or a threat for its portfolio. We can see that roughly 11 trillion US dollars in the bond market to trade at negative yields at the moment. So rising inflation would definitely be the pain trade for those bonds. And it might be anecdotal evidence, but we have seen in April that Business Week came out with a very interesting cover saying or asking, is inflation dead? And this reminded us of the very famous The Death of Equities front page of Business Week that they published in 1979, which was basically the end of the big bear market in equities. So from a contrarian point of view, it is clear the market does not really see inflation as a concern at the moment. But our incrementum inflation indicator, for example, is showing rising inflation. Due to the base effect, we will see higher inflation rates starting in summer. And we should not forget that higher inflation is exactly what politicians and also central bankers want to achieve with their policies. Therefore, from our point of view, inflation might be a contrarian topic at the moment, but you should definitely be hedged for rising inflation rates. When it comes to prices, we think that the fourth quarter of 2018 was a warning shot for many investors. We have seen that basically every asset class was down in 2018, and especially in the fourth quarter 2018. But we have also seen that gold was up 7% in the fourth quarter and mining stocks were up 17% in the fourth quarter. So gold perfectly did its job as a portfolio stabilizer in the fourth quarter. And it seems that gold reappeared on the radar screens of many institutional investors during that phase. From our point of view, we will see rising institutional demand, and this might be the big change in momentum that really moves the needle, because institutional demand at the moment is still fairly low, but everybody is following this massive resistance at 1360 to 1380. So once we're above that massive resistance, from our point of view, we can go to 1500 pretty quickly, because there is, from a technical point of view, no resistance to be seen. So that was a brief summary about the 2019 edition of the In Gold We Trust report. We're covering many topics. We've got a fascinating interview with Jim Rogers, we've got FOFOA, we've got the chapters about ESG, and we can just invite everybody to study this report. We think it's a special edition, and we all hope that you will have as much fun reading the report as we had writing the report. Thank you very much.